Okay, so we can talk a little bit about market update. And as of today, right, like when the COVID started, everyone was kind of in this situation thinking that the properties don't sell and the market is going to collapse, so on. But in reality is, so while everyone was thinking that the market is collapsing and so on, the market was actually moving. So you still could show properties, you still can come to the homes. It just was a good time because instead of, let's say, 10 offers, there were maybe 2 offers or maybe 1 offer. So basically you had less competition, right? So right now, as of May, end of May, let's say yesterday, oh no, 2 days ago, I submitted for one house in San Ramon. It was 7 offers. Today, I called up one agent on a Livermore home for my buyer, and they had already on hand 7 offers. So basically, yes, the market is moving, and it's moving fast, actually. So if something on the market with a good schools, right, and a good location, it will move. So to talk about what happens right now with the prices, right? Let's say on this graph, we just show examples of Fremont and Pleasanton. So basically, this is a list price, right? What people list the homes for. And the Pleasanton, yeah, it started to grow a little bit. Fremont, well, they already were overpricing properties, right, lately, but right now they kind of like mellowed down right here. So basically, list price, it's what the agents are pricing it for sale, right? In San Jose, if you look on a graph, listing price is kind of like flattening out. In Santa Clara, it's growing, it's bigger demand. So in San Jose, it's similar. There is like different areas. The schools are good, the house is going to go fast. So in a market, like let's say list price vice selling price, right? When we looked at January of the beginning of the year, right, everything was going really fast, and it was like probably in some areas people would put like 100K above the asking price, 50K above asking price. I've seen 200 above the asking price. I've seen 400 above asking price. The prices went crazy. So then COVID started, right? It mellowed down, and then why I was talking on the previous seminars, I would say that max price, if the market is going to kind of like go down, it's going to be probably 20% down maximum what can happen to the market, right? So, but right now, so how it would show, right? Basically, if the house was on the market for 1 million in January and somebody would come up and there is like 5-7 offers coming in, and then of course they're going to stretch it to probably 1.2. People would put 1.1, 1.2. So if we would see 20% like in potential going down, right, it would be that difference that people didn't have much of free cash, right? And when COVID happened, that's what happened, right? Like the market was unexpected, the stock market was unexpected. So people didn't have much of a free cash, and people didn't know what's going to happen. But right now, since as of today, right, we see it's coming back. So I don't see much of a differences right now. Of course, people don't put 100K. What I notice is some San Jose homes, which I call and I would ask, hey, did you, let's say they priced a house for $1 million, right? And then I ask them like, hey, do you have offers? They have like, oh yes, we do have 4 offers. And I ask, did the house hit 1 million? And they say like, no, but we prefer to sell for 1 million, but the house was appraised, not appraised, but the Zillow estimate says it's 1.1, right? So basically they're expecting at least 1 million. But let's say it all depends on the area where the house is located. It all depends on the schools. If it's very highly desirable area, it's not going to go under, right? You have to give at least to start from a listing price. If the house is hanging on the market like for 50 days, then yes, you can try under asking. So yeah, just a little bit update. I'm very active on the market every day, so I see homes everywhere. So sometimes my clients send me homes which I already seen before. And please, if you have, like any questions, you can write them in the chat, and I can go from there to give you more information. Okay, what's the difference between these two charts? Two charts, there is no difference. It just describes two different cities, right? Comparing Fremont to Pleasanton and San Jose, Santa Clara on the listing prices. What happens on the market as of today, right? On the listing prices, what the sellers are listing their homes for, right? Because in January, what happened when people started to have, January, let's say in Blossom Hill Valley, I was sure I can get my buyers a house, single family, for 1.2, right? I say like, okay, we're going to get it for 1.2, no problem, because I was like 1.2, it was more than enough, right, to get a very good house. So then January started and people started outbidding us, like basically 100K, 150K. My buyers first submitted at 50K, then 70K above, then 100K above. And so basically the Blossom Hill Valley in two-story homes, they hit like 1.3, 1.35. So of course my buyers would be like out, right? Because they cannot, basically if 2 or 3 homes in the area, they sell for 1.35, right? Everyone at the same square footage, they would expect these prices. So that just tells what these graphs just show, what listing price people are putting right now. They don't, like the expectations of sellers, right, depends on the demand on the market. Yeah, so we can go to the different slide. So on inventory, right? Inventory is amount of homes on the market right now, right? Let's say for the last 2 years, it shows again example of Fremont and Pleasanton. As you see, in April, we just like in May, right, we started to grow the inventory, which is really good. Before, let's say in January, it was very low, very low. So right now we're kind of catching up, but still it's not enough. There is more buyers on the market than sellers. And actually everything what is from new developments, everything what is built as of today, right, it's not enough. It's not enough. And actually the COVID itself, when the development stopped for a while, they postponed a lot of deliveries. That's even making it even worse, so we don't have enough homes. I'm hoping we're going to have more homes and then my buyers can buy, right? And still we're searching. Down at the bottom graph, we would see like San Jose inventory in Santa Clara. So basically in San Jose, we see growth. And I'm hoping it's going to come up too. Yes, to understand, a lot of sellers, they've been hoping that they would be able to do open houses by the end of May, right? But I think it's not going to happen. No open houses would be allowed. Still, I think it's going to stay the same way. We just would make an appointment, show the homes by appointment. And so right now, people who need to sell, they still going to put it on the market, right? They have to move, they have to sell the homes. So they can't, the expectations of open homes are, like they done. I don't think they're gonna, maybe in August that will happen, but who knows? Yes, and this is a graph of what happens with each cycle in real estate market, right? With every year recession or any crisis, right? So everyone is like, I have a lot of clients reaching out to me and saying, hey, the market is going to crash, the real estate market is going to crash. Well, it's not. So the problem, especially with what I'm seeing right now as of today, right? 7 offers in one house, 7 offers on another house. In San Jose, I had 4 offers. So buyers are moving, buyers are buying. So this just explains what happens with the market, right? If you look at the graph, every year, right, there is a little crash and then it goes up again. So real estate always will grow, even if we'll see a little change on this graph this year, a little bit, but it's still going to go up. So the price, like prices in Bay Area are very specific. They're very different from the rest of US, right? We don't have enough the homes for sale. We don't have enough developments, but the demand is big to buy. And then rents, right? Rents are very high. I have buyers who pay 4,000 rent, who pay like 3,500 rent, and it makes sense to buy for a lot of people, right? Of course, if you do live in Cupertino and want to buy a Cupertino home, right? So if you rent for 5K, it probably makes sense for you to rent there instead of buying with a small down payment. So you have to calculate your numbers and come up with what's good for you, right? Because every year you spend so much on a rent when you could put it in your equity. So so basically in this graph, it just shows that we're still going to go up. And then you have to take into consideration that a lot of homes in the Bay Area, specifically in the Bay Area, from about 35 to 40%, they purchased for cash, right? So, and they still are purchased for cash. You would see a lot of homes like 550. I've seen home which was like maybe in January, in January sold for 2.8 million cash, right? So let's say if you take into consideration all these homes which sold for cash, so would you even expect the crash to go what like people expect? Oh, I can buy apartment for 400K in San Francisco. No, it's not going to happen. You can buy maybe for 700K, right? So, but not 400K. So basically a lot of different moments here you have to consider. Steve, do you want to add anything?
Yeah, I just want to add, so everyone's probably kind of zooming into this number where it's minus 27. And a lot of clients, a lot of friends, even people that are a little bit older generation, they always refer to this time period thinking that like, oh, wow, like, this was down almost 30%. Let's wait for another time like this. But to be kind of honest and break it down, this time period, and the reason for this huge decline in value had to do with banking practices during that time. So banking industry was like they had no regulations at this time. I mean, of course they had some regulations, but the mortgage industry itself, 2006 to 2008, they were how do you say it, artificially kind of artificially raising values up. So anyone during this time, anyone could get a loan. You didn't have to qualify for it. You could literally, if like say you wanted to buy a house, your realtor could call an appraiser that's gonna put together a report, say that yes, I'm a licensed appraiser. I think this house is worth X amount. During those times, that person didn't even have to like show up to the property. They could have called and asked them like, hey, can you make this house value 1.2? And this person would say, yeah, no problem. And then they would do it. And then to add this to the lending atmosphere during those times where anyone could get a loan, the values were artificial. So it's obviously that, things were like way, way overpriced than they should have been. So once those loans went away, everything just crashed. People stopped paying because they bought those homes with value that wasn't really there. It was like inflated. So that's why the biggest adjustment happened during that time. And today, I mean, I've been doing lending 6-7 years. So today, none of those practices, none of those kind of loans without any verifications exist anymore. So yeah, I mean, it's a popular question. No one has a crystal ball, of course. In 10 years, we'll look at this chart and it's going to say coronavirus recession. I mean, we are in a recession. I mean, things are kind of looking worse and worse every day, but it doesn't always reflect real estate value. And that's kind of, a lot of people are thinking that it will happen again, but I don't know. It's tough to see it happening because that drop happened only because of lending, and that kind of loans and that kind of mortgage banks are not around anymore.
Mm-hmm. Can we go to a different slide? Yeah. Um, that's a little statistical data from MLS. It just shows you how it's the end of I think it's the end of April, right? Like based on, so it just shows that inventory went down from, so basically, yes, the difference, I can send you these slides. It just proves that we don't have enough inventory, but the homes are still selling. And the home values, you would see like in San Mateo County, the median single family, it would cost like 1.6 in average, right? And it would go in 9 days, basically about 104 percent above asking price, right? They don't go below. Then can we go to different slide? If somebody wants these slides, I can post them on my Facebook page and you can see them there. So this is about San Mateo County, right? I think we just talked San Mateo County, the other one, which was yes, San Mateo County, this is condo townhomes, right? That shows they go in average about 10 days and they still go above asking price, right? Some of them, which are not highly desirable, you still can get at the list price. Okay, can we go further? Yeah, it's, I'm not gonna go deep into that, but I can share that. Okay, buying homes during COVID. Yes, somebody asks to share the slides. Yes, I will. Real estate, you can find the slides on my Facebook page. If you go to my Facebook page, I'll post some slides in there. And please like our Facebook pages. So we have a lot of information, and basically I'm an agent who is very active in real estate, and I do post every update, right? What happens with a specific company, what happens with a BART extension, you know, like if there is interesting listing, I would share it. If there is any potentially good home to sell, right, I would list it, because sometimes I share, you know, like I look at the real estate as an investment, right? If there is a good house with a potential, I will always post it on my Facebook. You know, some of my buyers, some of my flippers, some of my friends, they would be interested. If, you know, like, of course I can post every house on my Facebook page, but only the ones which I think is a good investment in the future, right? Please follow us on Facebook. Yes, next, what I was going to speak about, it's about buying home during COVID, right? So basically, we are essential business as a real estate. People need to move, people need to to live somewhere, right? So yes, we are working, we do virtual tours. We can look at the properties virtually. I still every day I go with my buyers. I go with a couple of my buyers to like multiple homes, and they actively searching. We just have to put gloves on, again, masks, some sanitizers. Yes, some restrictions. Some people say don't touch the doorknob, don't touch the, so basically I just go and do it with gloves for my clients, right, to show what's in the closet, what's in the bathroom, what's condition property is, right? So basically, yes, there is specific safety measures, and we fill up some forms to protect our buyers and sellers constantly when we go show properties. That's basically it. The market is the same. We just don't have open houses, right? That's the only restriction we have right now. Uh, and yeah, we can go to the next slide. This is Steve for you.
Okay, before I jump into some economic news, it's kind of negative, but I think it's important just to kind of share it. I do want to touch on, so people still buy. Like, you know, today just closed a transaction in San Francisco. It was a young family, husband, wife. They just had a baby, and then they wanted to stay in the city. And believe it or not, they've been looking for over a year. And fast forward, not fast forward, but let's take back about 6 months ago. They were looking to buy, and everything that they liked was $1 million or like a little bit more. They even went as far as trying to find money from family, from friends, just to kind of add a couple thousand here and there to make them a little bit more competitive. And then they did make a couple offers for $1 million and still didn't get it. Now today they just closed a condo in San Francisco, and it was they didn't really have much competition. Maybe there was one or two different offers. So, anyways, so I'll get into a little bit more economy. Just wanted to share that as negative as these statistics are, Bay Area is a little bit different, and people are still buying. And even when I bought my house, it was 2 years ago in March. Many people told me that wait, don't buy. You're buying at the peak. But I mean, obviously they were wrong. Okay, so a little bit about economy and where it's going. So today, unemployment numbers came out for last week, an additional 2.5 million. This is for the whole nation. So there's not really any statistics to break down the Bay Area or Silicon Valley, because we do kind of carry the nation for the most part. But overall, so 40 million in 10 weeks submitted unemployment claims. Most jobs affected are in leisure, hospitality, so food, restaurants, and travel, primarily. I mean, it makes sense, people are not traveling, eating, so that's, well, at least eating out. Okay, and then on the next page, there will be a graph, just to kind of give you an idea. So today we're at 40 million in 10 weeks. If you look at the last recession that we just kind of went over on the different graphs where real estate dropped, that time, that was mainly affected by, mortgage practice, and it didn't really affect unemployment that much. You could see during those times, it barely even got to 1 million claims. Now we're at 40. So just kind of put it in perspective. It is scary, but most of the sectors and job categories that are infected or affected are not how do you say it? It may not be the people that are looking to buy homes. But and again, this is nationwide. Let's see, next slide. Okay, so employed. There has been actually some news in the Bay Area starting to come up. Like I have a lot of friends that work in tech sales, software sales. I mean, it kind of makes sense, if their biggest client is going to be a small business owner around the whole nation. So obviously, like those companies are going to lay off their sales team little by little, just because sales are down. So it makes sense. It doesn't really scare me or bother me. Some of the bigger companies like Tesla, Google, Uber, Google is saying that they're pausing hiring for the year. Uber, Tesla is laying off people, but again, that's kind of understandable because it all falls into that section of employment that got hit the most. Transportation. Um, well, Tesla, that's kind of its own battle, but I guess because of the shutdown of factory and stuff. Um, but it all comes down to the sales. So as we're into this pandemic and people are not spending money on these industries, then obviously those numbers are going to skyrocket. But it's not always directly affecting real estate or even stock market. I don't know how many of you follow the stock market, but what's going on is kind of like there's no explanation for it because stock market keeps rising, and then these numbers are out there. So it's something is off. But bottom line is it's not always all directly related to real estate, to stock market. Yes, some people are gonna get it bad, but it's not. It doesn't mean that you're gonna find houses for 50% off soon. And let's see, next slide, please. Okay, another thing that kind of ties it all in. I'm not sure if it even affects most of us here, but nationwide, there is about 8% of loans that are conventionally. These are loans that are insured by the government. That are in forbearance. Forbearance means that a borrower can apply, and they don't have to make their payment for 3 months. At the end of the period, they do have to pay it back, but it gives them flexibility not to make their payment by the first of the month. And then this one as well. I mean, more nationwide, of course, but about 20% of renters in the nation did not make their May 6th rent payment. The government is doing a lot though. Like, this is one of the reasons why I strongly feel like real estate may not get affected that much, is because what the government is doing in the last two months is, it's like times 10 of what they did all of 2008 recession. The amount of money they're printing, the amount of stimulus checks, the amount of unemployment benefits. Like I've even talked to a friend of mine that was in the tech sales industry, and they were making like base maybe 60,000 plus bonuses, of course. But now with the new unemployment benefits, like it's kind of like in his benefit to write it out and look for the next job, because the amount of money government is giving right now is it's unbelievable. It's I think they'll be able to somehow get us out of all this, and it's just gonna start picking up where we left off. Okay, so next slide. Any questions, please feel free. The chat pops up here, so I see it. A little bit on lending update. So underwriting. So the last 45 days, people that work for themselves have got hit the hardest. Like I have people now that are buying, that are refinancing. Even someone who's like a State Farm insurance broker for the last 20 years. Obviously, that's a business that it's every year insurance policies get renewed, and so income is pretty stable. But even for someone like that, a bank is requiring to go to the maximum right now to get a loan. They have to put together a balance sheet, spreadsheets, like things that a regular self-employed person might not even really have available right away. So for the self-employed, it's becoming easier, but I would still say a lot harder than it was 2 months ago to get a loan. Still possible. Low credit scores. Low credit scores. I mean, if I come across a client with a credit score that's going to be under 660, I would work with them to try to get it up, because there's not many programs. I mean, of course, there are programs available, but it's not going to be attractive. It's going to be really expensive, and it's going to be some online bank that you don't want to have anything to do with, because they might just drag you along, and then two weeks or 2 months they say sorry, but we cannot give you a loan. So yes, I work with people that have low credit scores just to get it up. Pretty much if I see a credit score, I could tell right away that, if you do this, this, and this, let's rerun it in 2-3 weeks, you should get a much different score. And jumbo loans. So jumbo loans are primarily like loans that you get from the big banks. These are going to be loans 766 and up. So people that are buying for $1 million, $1.1 million, $2 million, and they use jumbo loans to make this happen when they have down payment around 10 to 20%. So the big banks are actually not really interested in these kind of loans at the moment. So Citibank had the most aggressive purchase, and right now they're not doing it anymore. Chase and Wells Fargo right now is requiring 20% down on all their loans. Again, these are jumbo loans. We'll kind of go over the difference, but yeah, it's to sum it up, it's getting easier. It's getting a little bit back to how it was pre coronavirus, but at the same time, it's still going to be a little bit tough for some people to get a loan. Okay, so that's lending. Now I want to just kind of go over the type of buyers that a first-time home buyer might have as their competition on the market, and to kind of go over how it might make it hard for that person to buy. So one of the most popular ways, and I mean, this happens to a lot of people I come across, like I've been doing loans for 6 years, and I have people that within that time are already on their second house. So it happens a lot. People buy something just to get in because rents are high and they have money just sitting in the bank where no, they're not, you know, they're getting like $2 a month on interest on this money. So it kind of makes sense to put it into something in a good area that's going to grow later. You could sell it or take it back out. Anyways, so one of the more popular ways for somebody to upgrade when they already own a house is to do a cash out loan. Cash out loan is, in simple terms, it's when you access the equity that you've gained and appreciated over the years. So here, for example, so say a family bought a house for 800,000 and they have a loan for 350,000. So maybe they put 120, 160,000 5 years ago. Then the prices went up. So right now the value it's a little bit higher. So what one of the most popular things to do, and this is assuming that they want to keep this house and they want to buy a bigger one and rent this one out later. So what people would do is they take out a new loan from this house for 520,000. Let's just say interest rate is 3.5, and the payment on that would be 233.35, or sorry, 2,335. What this does is it pays off their original loan for 350, and it gives them 170,000 in cash. Now this cash, the lender doesn't really care what you do with. You could buy Bitcoin, you could put it in the market, but in this case, the most popular way is this family would use that money to use as a down payment on the next house. And then the loan stays. So you'll have this loan fixed there for the 520,000. That doesn't have to change. And then let's just say that over 5 years they were able to accumulate some more cash, and let's say that they added another 130,000 to this, and now they're ready. They have 20% down, so combined they have 300,000, and now they want to buy for whatever reason. Maybe their kids growing up, they need better schools, or maybe they had more kids, and now they want to use this 300,000 and buy a $1.5 million house. So that's exactly 20% of that. So basically, this was a way where somebody doesn't have to accumulate 300,000 to buy a bigger house. They could basically access some of the equity that they've gained on their current house. But today, these kind of loans are pretty much non-existent. So when COVID took place, a lot of banks stopped doing these loans. Like, you cannot go to Wells Fargo right now and say that, I have $300,000 in equity. I want to take it out and I want to buy something else. Chances are they'll probably say, no, I'm sorry, because we're not doing these loans. And many banks are slowly, or not slowly, but many banks are following the same guidelines. And these loans are becoming less and less doable. If you do find that it's going to be interest rate that's so high that most people would just say, no, I'll find money somewhere else, or I just won't buy a bigger place. Okay, so long story short, why I show this example, this is another buyer on the market today, that could be a competition for a first-time home buyer trying to enter the market and get their first property. So this kind of buyer, where 2-3 months ago there were a lot of them, because as interest rates drop, people want to upgrade their house, they want to get something bigger. Today, that buyer is not really on the market because they cannot access their equity at the moment. So the amount of buyers is decreasing just because of this. And then another reason that's more lending related. So on the next slide, it's going to be jumbo loans. So just about 2-3 months ago, so anyone that had 10% down would be able to take out 2 loans. This is called a piggyback loan. You can Google it. It's basically you're getting 2 loans and you're bringing in 10% down. So for example, on a 1.1 purchase price with 10% down, you would get the first loan from one bank at 880 and the second loan for 110, and you would bring in 110,000. So this was the best, probably the most popular way to structure this deal. This is a loan structure that was around, years ago, and I think it will come back for sure. It has to come back, but at the moment, this changed a lot. So say this buyer only had 10% down 2 months ago, and they were in the market. Today, most banks are going to require them to have 20% down. There are some banks, I know Citibank is doing 15% down. Their underwriting is not the easiest to get it, but the program does exist. But anyway, so that's a difference in 5%. So that same buyer today would have to come up with additional 55,000 just to buy the same property, just because the program's changed. And again, I mean, maybe they have it, maybe they're counting on stocks to liquidate it and happen, which is another kind of catch-22 because stocks are down from where they were to open the year. So, anyways, another example that a buyer that was approved two months ago, right now, may not be competition or may not be on the market because of the way the loans and programs have changed. Okay, no questions? It's a lot of information. Um, okay, now just kind of my, like I said, I bought my property when most people said that, you know, it was the peak. It was an up and coming neighborhood in Oakland. And a lot of people said that, you know, don't buy, this is 2008, like this neighborhood should never be like close to a million, blah, blah, blah. Anyways, now long story short, it's appreciated since then. I was able to refinance my mortgage. That's another thing. So when I purchased my property, the property was in the 900 range. Not bragging, but just to kind of go over the numbers. In that range, I was able to put less than 10% down payment for it, and to use this first-time home buyer program. I mean, we could go over a little bit more into it, but buy now or wait for a potential drop. I guess, I mean, I'm not a lawyer. I know a lot of attorneys, but the most popular answer in the attorney world is it depends, right? But same here. It does really depend. You know, if we come across a lot of buyers in San Jose, in San Francisco, that are paying over $4,000 a month in rent. And in that situation, I mean, if it's a young couple or if it's like a single person and they don't really need huge space, and they have, you know, some money saved, I think in San Francisco you could find something that will be kind of on the same level. And then also, how competitive is the area you want to buy in? I mean, me and Lily, we work with families that have kids from time to time, and it's kind of spread out. Some kid will be in elementary school, one will be like leaving elementary school, and then they're 2-3 years away from high school or middle school. So it's all kind of plays a role in the decision of our buyers. But at the same time, those markets are usually very competitive. It's kind of rare to see a property there on the market for, you know, over a couple weeks. And I mean, that's kind of basic supply and demand. It's in that situation, it might be kind of tough to get in there on a good deal. You might have to even pay a premium at the moment, just to secure a house there, with the good schools, the good zip codes. Also, how strong is your offer? It's another thing that I wanted to touch on. I mean, I help people with all different kinds of loans, like, you know, 5% down, 3% down, 10% down. But one thing to keep in mind is, you know, the economy starts to pick up again, and people are able to walk around freely and like actually look at houses and go to open houses. If the mortgage rates continue to stay this low, like on Tuesday, this peaked at, like, you know, almost the bottom that it's ever been. If the mortgage rates continue to stay this low, and things start picking up, I think it's going to be really hard for well, I'll give you an example. Say that you're selling something and you have 5 people that want it. One person is going to commit 5% down and then 95% loan, and then you have another person that's going to commit like 25% down in cash and 75% in loan. So from a seller point of view, 9 out of 10 times, even if you write the nicest letter, how you really like their house and you know you want to raise your kids there, I mean, from a seller point of view, it is going to come down to the number. and how strong your offer is, what your financial situation is. It's really going to dictate that, you know, if you see something you like, take action on it, and not wait to see kind of what will happen in the future. And then income, of course, like, you know, it's all those numbers we shared are more on a national level, but at the same time, we are starting to see it more and more here in some sections. And if you're if you made, you know, 200,000 last year in IT tech sales, you might want to consider, like, you know, is this going to be sustainable? Like, you might be really good salesman, but there might be a time where that job, that product is just not selling. And so, I mean, there's a lot of factors to consider. If it's the right time to buy now, wait a little bit. Is there going to be a price drop? Will there not be a price drop? I mean, to be honest, no one knows. I wish I knew. You know, I could probably host some kind of thing online and just tell people what the values would be on real estate in the next couple of weeks. Um, but yeah, so it just kind of comes down to case by case. And let's see. So, oh yeah, so next slide. If any questions, feel free. And then next slide, just to give you an idea of what the rates are today. Let's go next slide. And this is a real example. It's kind of interesting. Like, you know, I get a lot of calls that, I mean, we do these seminars a lot. And people are often like very surprised how you could buy, well, how the rate is so low, even if you don't have 20% down. And another thing on the mortgage insurance. So let's take a look at this example. This is a 30-year fixed mortgage rate. I pulled this like 2 days ago, so the rate is the same. It's been pretty stable. And this is non-jumbo, so this is conventional loans. Conventional loan in the Bay Area, outside of Sonoma County, we're pushed to 765 600. So this is the maximum loan amount to use this program. Anything on top of that is down payment, of course. So here, this is a real example with excellent credit with 10% down. So say it's a $850,000 townhouse or house, and you put 85,000 down. So your loan at 3% is going to have a mortgage payment 3227. Because by rule, anytime you put less than 20% down, there is going to be mortgage insurance. And in this case, you put in 10% down, your mortgage insurance is going to be only $127. So what this equals is $3,354. This is mortgage only. Yes, you'll have property taxes, insurance for the fire separately. And property taxes you get to deduct from your income. Part of the mortgage you get to deduct from your income as well. But if we're just looking at the mortgage, you're going to be at about $3,354. Now, very interesting case. 5% down, same exact scenario, but here, let's say you want to put only 30,000 down, 36,000 down instead of I'm sorry, 40,000 down instead of the 85. And 5% down. Most interesting thing is the rate is the same. So banks are not, so this mortgage insurance is actually a private company that insures the lender in case of default or anything like that, where they basically get their money that they lent you back. So they, in kind of short, they don't really care. They're giving the same rate for someone that puts 5% down or 10% down. So here's an example where the only difference is the mortgage insurance is $51 higher. But you're putting $42,000 less down payment. I mean, it's a pretty nice trade-off. I think most people would keep $42,000 in the bank and then take a $51 a month higher payment. And then the most important thing, actually, before I get into that, mortgage insurance is such a tricky thing. I get a lot of people that are, you know, sitting at home on their couch on Redfin or Zillow, and they start playing around with these calculators. And for some reason, when I quote them the mortgage insurance, or I let them know that, like, hey, you know, this is only going to be like $127, they're like, wow, like when I played around with these calculators, they told me it's going to be 300 or more. So it's a little, I'm not sure where it's coming from online, but be careful with online calculators for mortgages at least, because they're not going to give you real numbers. It might actually scare you a little bit. But oh yeah, so most important, so mortgage insurance falls off. So say you consider the first option where you put 85,000. Now this $127, once your loan is paid down by an additional 10% or 85,000, that's gonna disappear forever. You won't have it anymore. I mean, I come across different people. Sometimes they get RSUs, they get stocks, they get money somehow, and they're just sitting in their bank, paying them like $2 a month. So in that case, it makes sense, pay it towards your mortgage. At the end of the day, you get it back. It's your equity. When you sell the property, you get it back. I work with a lot of European clients, and it's like in their custom. I think some of my Asian clients are the same way. It's in their custom to try to like pay off this loan in 5 years instead of 30 years, which is cool. Like, it's more and more power to them. But it's, I mean, I think it's a good thing to try to pay it off, because when you do sell or you refinance or anything, you always could get that money back. So it's not like, you're giving it away forever. You're paying it to yourself in a way. You're putting it into a bank account that's tied down to your house. Okay, so that's a lot of numbers. Sorry, guys, but it's just wanted to kind of show difference between that. Any questions? We're here. And yeah, so any questions, type away. Okay, if not, we could, so this is gonna be part 2 of our seminar or webinar. It's just gonna kind of go over how a purchase contract looks, what the steps are, and kind of, yeah, so Lily will take lead.
Yeah.
Go from here.
So thank you, Steve. So, yeah, I'm going to talk about purchase price. How does it go? And it's a second part of our presentation. So, if you're a first-time home buyer, it's very good information for you to hear. And just wanted to add about the market, right? So I just recently started seeing, I have some clients looking in San Francisco, and I've seen very nice properties coming up on the market. This is condos, 1 bedroom or 2 bedroom, and they're looking right at the ocean, right? I just saw one pending, and perfect apartment. Basically what happens, it's actually Airbnb got influenced by all the COVID, right? And basically people who got the big loans for the purposes of renting out Airbnb, they cannot sustain, right? They have to put these properties on a sale or long-term rentals. So that's why we would see that's what I'm expecting, and what I'm seeing in San Francisco, there are going to be more and more properties for sale, specifically with views and so on. And then yeah, so I had something else to add, but got off time, I forgot about it. So let's go and discuss how to buy, right? At the beginning, I have a lot of buyers. Oh, okay, there is a question. For the sake of investment, do homes in the Bay Area appreciate more or less than other upcoming tech cities like Austin? That's a very interesting question, actually. Yes, I've been looking up the tax Austin recently myself, and especially where Google is building the complex, right? Yes, I think around this area, potentially homes are going to be appreciated, but I don't know for how much. I don't think it's going to go generally much bigger, right? Like, because you have to understand the techie people who are going to go and work in Austin, they salaries adjusted to the state, right? That's not going to happen like they're going to have the same salaries like in here and going to work there, right? So basically, yes, there is a potential, but I don't know how much they're going to appreciate that. In here is still it's gonna appreciate, and the value of real estate is because demand is so high. I think it's gonna, I don't know what's gonna happen next, right? But nobody knows what's gonna happen next. So yes, but if you want to invest in Austin, you have to look at it. And if you plan to live here, and you have to look at it too. So it's all personal. You have to see what's your financial situation, what's your work situation, how much down payment you have, but you know, um, there is a lot of things to think about, right? Yes, as again, if I would have a crystal ball, I would say like, oh, okay, like Austin would depreciate like 100%, right? Like, and then I would invest myself in Austin. So, but I don't know. Um, let's see. Like, I'm gonna go over the slide about the purchase and how to do. Thank you. Yes. So about the purchase, like let's say I have a lot of clients coming up to me and saying that, hey, we are ready to buy, right? How to start? So what we do, first I have to find out what's the value, what's the price do you have, how did you pre-approve, who pre-approved you? So I always ask them to go and talk to Steve, or you know, maybe somebody comes with their own lender, but yeah, I would recommend Steve, because it works, right? Like we always got constantly offers accepted, and some cases we actually overbid cash offer together. So that's possibilities. Okay, can you explain a bit more about investments in East Bay, since many are going to work from home and move out of San Francisco? Do you think prices are going to appreciate more in East Bay? So working from home, you know, like, yes, we are gonna work, majority we're gonna work from home, but for how long, right? Like, how would it influence the market here? I mean, like, if people move out from San Francisco, I don't see a lot of people moving out from San Francisco. Like, I mean, like, if I would live in San Francisco, I would never sell my apartment there. So I want to buy myself apartment in San Francisco, right? That's what I said. If the San Francisco is going to sell off, it's only probably potentially it's Airbnb rentals, because people can sustain these mortgages, and they can, you know, I have a friend who rented one bedroom like for up to $600 a day, and now she can't rent it out at 120. So you see, like, people who like, but you know, so you have to see the situation of people. If they rent, I mean, like, if they own a lot, like on a loan, right, that doesn't make sense for them to keep these apartments. So on East Bay, yes, we are gonna see, like, still there is a big demand, right? We are gonna have if we're gonna have the same amount of buyers, like 5, you know, I see all these multiple offers still, I see that, right? So we are going to grow. If it's going to be not enough homes on the market, right, that's what I'm expecting, more inventory. But if we're going to stay at the low inventory, I don't know, in summer it's going to be crazy, right? Like it is going to be crazy. So, but you never know. Again, it's just my predictions in the next couple months, right? So also in the East Bay, let's say San Leandro, San Lorenzo, Hayward, right? They are growing very much, right? Why? Let's say from investment point, if you're an investor, right, in you buy there, you can afford a house at 600 or 700, right? So basically, but you can get a rental price at 3K, right? Basically, if the buyer buys from investment point, right, why would they buy a house for $1 million when they can buy for 700K and get 3,000 as a rental, right? So yes, it was a big trend for the last probably half year. There was a lot of purchases in Hayward, San Leandro, San Lorenzo, because still affordable with a good return of investment. And in Hayward, there is some areas, very nice areas, and I'm thinking, you know, like I've seen some, I sold a couple homes there, and I sold one close to Mission Boulevard. We actually got it in the winter for 600K. and it was 3 bedroom, 2 bath, small square, but it was original, from original owner. And what happened, my buyers just remodeled it for, they invested like 60K, but right now the homes the same size with remodeling, they sell on this street like for 730 and higher, right? So they still in a possible gain. And I think on this street I've seen like they don't have a really good schools in the neighborhood, in the specific Hayward neighborhood where I sold, but I've seen on the street families moving in with kids. So I don't know where kids are going to school, right? But people see potential there. So but you have to see area to area, right? Hayward is specific. There is like a lot of good areas, a lot of potentially growing, a lot. And then about working from home too, right? When we think, like, I've been on a lot of forums and chats where techie people will say like, well, we can live from, like, we can live anywhere, right? We can go to different state and live there. But it's in the news, I think it was Facebook or somebody announced that they're going to adjust salaries to the states where the people are going to work. And plus it's going to affect people's possibility to grow in a career, right? If you're going to stay specifically in a office location, right, and be working in an area where the offices are, right, you probably will have more potential to grow and to get promotions. So that's number one. And honestly, like about investments, right, you have to see potential areas, what's going to happen next, and nobody knows. But yes, there is still potential to grow in some cities. You just have to look up and what's going to happen. Yes, and for families, let's say, again, without the kids who don't plan, you have to look at it like that and invest, even at purchase. I'm looking at everything as an investment, right? So basically, you don't have kids, you're a couple who work in tech. You don't have to go and get a house with a good school, right? You don't have to go to buy a million, 1.5 home. You can go and start with a potential for, you know, like for growth with a townhouse, with a condo. It's, you have to look at it as, hey, I'm not going to have kids for the next 8 years, right? What's going to happen the next 8 years? You just, instead of, if you buy something close to the commute, like close to BART, close to these BART stations or Caltrain, in a good area, right? Even if it's small apartment, it's still gonna sell in the future, right? It doesn't matter, but you're gonna grow your equity. You buy it instead of paying a rent for 4,000-5,000 every month. Like, you basically buy something, live there for 8 years, and then resell it. Maybe in 8 years, or like before you're gonna have a baby, and so far you can have so much equity already in one property, right? You have to see, there is like a lot of properties on the market. Some potentially will grow in the future. Some, you know, some of them I would see like close. I would recommend you, like, when we work closely, some buyers will send me the home close to the highway, right? I say like, no, close to the highway is kind of not an option, right? Because close to the highway, right next to the highway homes, they tend to stay on the market longer, right? So basically you have to look at this different options. What's the potential for future for the property, right? Yes, so let's go back to the purchase process. Yes. Okay, so the buyer comes in, and you as a buyer come in and you would ask me like, hey, I want to buy a house, where to buy, what to do. So if you're not pre-approved, I would recommend you to go to Steve, right? Oh, like, I mean, this is the best option because I work with Steve every year and he's doing everything fast, and he's a good lender, believe me. So you can call Steve, you can have a fast chat with him and get a pre-qualification really fast. So basically he would ask you what salary you have, how much down payment, and he would say, yes, this is your price, let's say 900K. Oh, let's average, because average homes in the Bay Area 1 million, right? So he would say 1 million is your price, purchase price, right? So then the differences between pre-qualification and pre-approval. Pre-qualification, you just call, really fast chat, and so far. Pre-approval, when you call and Steve sends you application form, and then he starts getting your paperwork, your pay stubs, and basically he starts looking in your credit score, and then he gets your pre-approval. So when I know your price, which is $1 million, right, say, right, average home price in a Bay Area, so we go house hunting. So in a house hunting, right, like we have a different situations. There is a lot of thinking that I mean, like, I'm as a real estate agent, I would get to know what's your requirements, what you're looking for in a house, and I will handpick some items. There is a lot of websites who post the homes. I have my own off-market listings groups where I am in. So basically I search in there. Sometimes agents post something which is upcoming soon and so forth. But yes, some of my buyers, they send me the homes they like, right? Basically we're always on the chat. I send something, they send something. Yes, I do sign you up. I can sign you up for the MLS listings. So yes, they basically would come and the listings would come to your email. But so it's kind of a spam, but yeah, I like to handpick to the listings. And yes, all I need is the address, right? And if you like a property, I can find out more information on a property, if there is inspections, if there is a potential. So one of my buyers just keeps sending me some of the homes, but then I say, like, do you realize it's close to the road, right? Are you comfortable with the road? And they say, no, let's pass on it. And I say, like, hey, this HOA planning to do so much work on the condos, right? Are you, like, the HOA fees probably will raise in the next year. And they say, oh no, let's pass on it. So if there is a potential for flood and there is a flood insurance needed for the loan, yes, I would say probably not the good option before we go even to see that. So some of the homes I will do pre-screen them before we go and see, because sometimes it doesn't make sense from, but if you like the house, yes, we can, but before that I will tell you what's the pros and cons of this property, right? Yes, then when we like the house, let's say 1 million, I would suggest, like, if you're pre-qualified for 1 million, don't restrict yourself, right? I always ask my clients, if you go and to some websites and you go and say, like, price point is 1 million, and then you restrict yourself to 1 million, don't do that. Go to 1.1 at least. What happens is sometimes homes, they drop in price. Sometimes homes at 1.1, they hang on the market for a long time, right? I had a property which was listed for 1.250, and we actually got it with my clients for 1.1. So it's basically 150K down. So the only reason why it happened, the listing agent, he overpriced the property. He listed at 1.25, which never, like, this amount for the purchase price, that never happened in the area, right? Nothing sold at this amount in the area. So basically when people look at it, they think it's overpriced. Then search, when people put a limit at 1.2, let's say, they don't see this home in the search, right? And basically this guy, he just overpriced, and because of that his listing was longer on the market, longer. And then, but this house right now, it's valued over 1.3, right? Because this just was a moment and the way agent listed the house. Yes, to understand, if you are putting your homes in a search and you pre-qualified for 1 million, don't set yourself, don't restrict yourself to 1 million. Set a search to 1.1, and then you will see these variations. Sometimes we can negotiate, and I'm good negotiator. If something is really makes sense, right? If the sellers are desperate, they just gonna negotiate with you. Maybe we drop it by 50K, and the house with the potential makes sense to put like 1.50, right? Or maybe one. So it depends. So let's say we found